We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today again is Nate Fisher from renaissanceman.org. He's a systems analyst, writer, and precious metals investor. How are you today, Nate?
Good. Thanks for having me back, Tom.
Excellent to have you back. And, you on your blog write about all of the manner of things. The first time we spoke was around, the idea of Eric Sprott becoming probably one of the richest men in the world around, resource investing. And you had penned an article, explaining your thinking around this, and getting to know you over the past couple months. It's been really interesting to kind of see the big ideas that you think about and the 50,000 foot view that you piece all of this stuff together from. So, right now we're recording this on the morning of October 25th, and we've seen some exciting price movements in the metals in the last week, but we're coming into a really important time of the month, and that's the options expiry time. So you've been updating a chart and recognizing a pattern coming into this period. So can you explain to us what you're seeing and the importance of the timing here?
Okay, you see the charts. Okay, so this is the first chart where I call it the silver beatdown. To have some fun with it. Pretty much around March or April of this year, I noticed that there was a pattern evolving. I didn't know what it was at the time, but I was noticing pretty much around the 18th to 20th of every month, somewhere around there, the silver was getting smashed. And I just figured it had something to do with the monthly futures or whatever. I didn't know what it was until I saw someone's other post about the silver options getting smashed that time. And I'm like, well, wait a second, that's kind of corresponding with my circle in here. And then I went back and I noticed that all these things were right around the futures options monthly expiration. So the last 6 or 7 months or so, I've been playing this pattern where basically I was buying some small levels of options the day after the options expirations. I'd hold them for a week or two. I'd make $500 to $1,000, nothing crazy, but it was more of kind of like a proof of concept. Basically, I made a much bigger investment this last time around. I made, I don't know, 3, 4, 5,000 if you total it all up in the last 2 weeks on this. However, what I think we discussed a little bit ago, that I think it might be end of trend, but I don't want to get ahead of myself here. But as you notice, this chart here has the beatdown, and this chart here has what we called the recovery period. So pretty much what I was suggesting as a possibility, as I'm not in the futures business, what it looked like what was happening was an actor, whether it's a bullion bank, a hedge fund, or a guy with a funny mustache was being evil. What looked like what was happening was that the call options were getting smashed pretty much every single month by an entity. And you could see on the CME page, you can see where the call options are for all of these things. And what it looked like what was happening was, as soon as these options expirations would go past, it looked like then there was a recovery period for so much time. So I documented what all of these recoveries were. Well, most recently, as we noticed, the last 4 months or so, silver was going down. I was playing this volatility every single month to, make some grocery money or whatever. And what I noticed this month, I'll comment on some of these lines here then in a second. But what I noticed this month was my green circle was predicting about $1.50 recovery. And I noticed this downtrend here was at the 50-day DMA. And it also looked like it was the top of the channel trend. So I figured, okay, $1.50, and we'll see where it goes from here. Is it going to get rejected from the top of the channel and it's going to go back down? Or is it going to break through the channel and move up? So from that, we noticed the last couple of days, it looked like it broke up through the channel. And where I was noticing a beatdown should happen we just noticed a strong move up. And it looks like right now it's kind of bouncing off the 100-day. I have some lines here where who was it? Brady was talking about there was a good line and a bad, not so good line, that if this was rejected off of here, it looked like it would go down. And if it went down below this, then Brady was suggesting that the price could continue to go down much further. Whereas he was suggesting if the price went up above this line and held, that the bottom was in. And Michael Oliver was also talking about a weekly close above this line. If we were above this line or so, we would be good with his momentum structures. So do we, I guess tomorrow, I have this thing listed where tomorrow, the area here, it could be where, we could have another beat down in the morning. I had heard that the ECB might be having a dovish tune, and this might make the DXY go higher, and they may smash it by $1 or $2. Don't know, but by tomorrow afternoon, I believe, is when the options expiration is. We should be good to go. But even so, I wouldn't necessarily buy right after it, because look at the RSI for a lot of this. So we were talking about this beforehand that, even if we are out of the woods here with the beatdown, I think it's quite possible that my pattern that I'd seen over the last 15 months could be over. This could be the end of trend.
Mm-hmm. Yeah, it's really interesting to see how the price has broken out past that trend and the 50-day, like both of those moving averages. But as you point out, the RSI seems a little bit overheated. So what do you think is the time limit on seeing a reversal on that and or a confirmation of that break?
So I think there's probably much better people qualified to answer that. But in the next couple of weeks or so, you have a couple of things coming up, the possible taper with the Fed. You have this week, you have a couple of things happening where, like I said, the ECB could have a more dovish monetary policy, which could reject this a little bit more. I know Brady talks about the possibility where we could be seeing a DXY hitting up to 96 coming in the short term. And then that could be pretty bad for gold and silver. So basically right now I'm at like 25% cash. I bought some juniors over the last couple of weeks down here where it looked like this was a bottom. So I took a lot of people's advice and I just bought little tranches of some of my favorite silver miners, and some of them, they went up like 50% in a week. So I'm like, okay, I got to sell out of that. So right now I'm at about 25-30% cash, and I'm just kind of playing a wait and see right now, because the big thing that you have with like a Michael Oliver is they're talking about a possibility of like a next level of where silver is going to base at, which might be like $30. So whether or not I deploy all of my resources at $26 or $28 to go up to 50, or whether I take a huge risk right now and I could get a smackdown, I think it's smart for me to have at least, 25-30% cash at the moment. So I don't know, maybe I'll nibble a little bit at some undervalued stuff on Wednesday, but I think a lot of us have seen these beatdowns and are very nervous. And I think that a lot of people call that the wall of worry. Mm-hmm. So I think right now it's a kind of a wait and see approach rather than, hey, I'm all in at the moment. So find some value where you can, find some, I love finding some juniors that are significantly undervalued and maybe buy a little tranche here and there and kind of dollar cost average them up, or, if they go down further, buy a little bit more.
So when we zoom out again with this 50,000 foot view, Nate, you were explaining to me before we hit record here that we've seen the cup and handle build for gold, but you were explaining to me that we really haven't seen that for silver yet. So show us that chart and as you explained, kind of that new basing pattern for silver.
Yeah. So, from 1980 until 2008 is where the cup was formed for gold, where that hit the 800 high of 1980 to the 800 or so in 2008. And then it looked like the handle was formed from 2008 to 2011 or so, where it went up to 1923. So that was the gold move of the cup and handle. But if you really look at it here, it looks like the silver just formed a cup from 1980 to 2011. There was no real handle. It just looked like it met the all-time high. So I had heard someone else talk about this a long time ago. So it's quite possible that there's a lot of people that believe the same thing as this. I don't know, but I was thinking last summer, like a lot of people, that hey, gold has hit its all-time high. When is silver going to hit its all-time high at $50 with its cup and handle? And I started digging in a little bit more. And as you know, I did a session a little while ago with Patrick and Kevin, and they talk about ARCs a lot. And I started looking at my stuff through the lens of what they were doing with ARCs. And this probably isn't precisely what they were doing, but what I was looking at was I thought that the silver potentially was just the cup from 1980 to 2008. And from what I had heard people say, the cup and handle, the cup forms in a certain amount of time, and then the handle forms like in a third of the time. So if we do 1980 to 2011 or so, you're looking at 30 some years, and that would be about a 10-year for the handle here to form for the silver move. So this looks like, if you do that measured move, this is how I think a lot of people, even like Keith Neumeyer, could get your $100 silver quite easily if this technical pattern does play out like it does. Now, this green area here is where Michael Oliver was talking about how we're up in this new basing area, and we've been since 2020. And he goes into a lot of his momentum structure. And I don't pretend to be a Michael Oliver momentum structure expert. I just find all of that fascinating. And he talks about, if silver meets a certain level, then we're going to hit a new basing pattern. And this new base may be, maybe a rectangle a little further up, and then we may base a little higher up. And so then this next basing pattern, like you can see right now, we're in this sideways channel for the last year or so. Now people, can see the silver high and then how it got knocked down, but you can see these channels where they trade sideways. So Michael Oliver is potentially suggesting that maybe once we go over 30, we'll be in a basing pattern between 30 and 50 for a while. And that corresponds with, I have the momentum structure brought up here. And then if you're looking at the momentum structure with all of the arcs and all that other fun stuff, you can see down here how this plays along with the RSI on a weekly here. Whereas like if you're at the bottom of the arc, you can see how this RSI goes all over the place. But if you're in the downside of an arc, you can see how the RSI typically stays between 30 and 50. And the upside of an arc, you can see how, generally speaking, you're between 50 and 70. So what this looks like is potentially that this weekly, over the next couple of weeks, months, whatever will be, you'll be bouncing back and forth in here. And then eventually we're going to hit this new basing pattern on our way potentially to 100. Now, is that next month? Is it next year? It's probably a couple of years out. But we had talked about some other things with solar and investment reasons why some of this might actually drive this as well. We can get into.
Yeah, those real fundamental factors could possibly help push that price. And it's interesting to look at the technical patterns. Obviously, it looks like you could draw a pretty nice arc on that handle, but stepping back and thinking about the fundamental factors of the investment demand, the momentum driving that investment demand, as well as demand from solar, as we're seeing, higher energy prices, all of this stuff play in. It's interesting to see what could contribute to that $100 price, right?
Yeah, we were talking a lot about the energy stuff beforehand, and I was letting you know that, if this inflation thing is taking hold, and now it's starting to see that, even Jack on Twitter is talking about hyperinflation. Now, I'm not saying we're in hyperinflation, but if it's now widely kind of agreed upon that we're in some sort of inflationary environment, I told you about the Rafi Farber quote that he probably mentioned to you about how, if we're in inflation, like before inflation, people buy what they need. But if you're in inflation, you're looking at a situation where you want to buy what you need in the future now, to kind of, minimize your costs. So I'm looking at it like, if you want to buy a bunch of meat right now and freeze it, it's going to be a lot cheaper now than if you wait a year from now and beef prices are 50 cents. Mm-hmm. So this demand then also kind of spirals into creating more supply chain issues, which then further creates inflation. So it's a self-fulfilling prophecy, if you will. But with that, I'm looking at, well, okay, my food prices might be higher a year from now, but I think my energy prices can be a lot higher a year from now. So I started going down that rabbit hole of solar, and we can talk about that a little bit if you want, but I wrote a little bit of a series on that. But the big picture with the solar concept is that it's, go ahead.
Maybe before we move on to, the inflation deflation thing, which I want to get to, let's touch on one more of these relationships as it relates to trading. Basically, you forwarded me another article about looking at the values of basically the GDX compared to gold and the SILJ compared to the silver price. So let's go through that first before we move on to the inflation side of things.
Not a problem. So basically, I wrote an article about this a couple months ago, and it more or less kind of predicted a much higher GDX price was coming in. I'm very happy about that. But what I was doing was I was essentially going back a year or so, and I was taking the price of gold divided by GDX and taking the price of silver divided by SILJ, because I'm like, in my head, if I'm buying options of like SILJ, so let's just say I want SILJ at $17 in January, 3 months from now. Well, what silver price would I be expecting in order for SILJ to be $17? So that's what kind of got me there. And I'm like, well, you know what? Let me take a look at this relationship. And what I noticed was with the gold to GDX at the time, that gold was extremely overvalued to GDX. So if this was some sort of, I'm using I'm stealing this a little bit from statistical process control in my other career. But if you have an upper control limit and a lower control limit, then you have some sort of mean here. The idea is that over a course of a period of time, there would be a mean reversion. So if this would to mean revert, it would show that the gold price would either go down or the GDX price would go up, or a combination thereof. So what that was telling me is that GDX was pretty much a good idea to be a buy over gold at the time. And I did the same thing. So this is a gold chart, but I did this further down with SILJ, and it showed me the reverse. It showed me that a whole bunch of the SILJ options I had was a very bad idea. And I wish I had done this before I bought a bunch of the SILJ options. But the concept was that SILJ was extremely overvalued to silver, meaning that it kind of had a lot of strength. While the silver price was going down, SILJ was kind of going sideways. So SILJ had a lot of strength. And basically, at that point in time, it was probably better to buy silver than SILJ. So that's kind of what I was looking at with them. And I haven't updated these charts in about 2 months. But I would suggest that if you take a look at those charts of you divide silver by SILJ or gold by GDX or Huawei or whatever index you want to use, you can kind of see if GDX or SILJ is overvalued or undervalued to the underlying metal at the moment. So that was kind of where I was going with that. And if you look at that, if GDX is completely undervalued to gold, then you start thinking like the big gold miners like a Newmont or a Barrick are undervalued to gold because they make up a lot of the GDX index. So that's kind of how I'd be looking at maybe a good time to buy miners, or would that suggest maybe gold would be coming down and like, so it was just kind of a tool to use in concert with, some of the technical analysis and fundamentals. As you probably have seen in some of my writings, I love the technical charts. I love looking at stuff, but I use it as like one of 10 things as part of my thesis. So other thing might be mathematical models. Other things might be the fundamentals. So, and I love a lot of the guys you have on, by the way, because I don't think a lot of the guys that are on your show realize probably how much people use them for investment. So maybe they shouldn't, but I think it's a lot of people learn a lot from there. So if people understand that a lot of investment is probabilities, and don't say that, hey, Nate said something is going to $1,000 next week. Look at it all through the lens of probabilities, and hopefully that the guy you're following is more right than wrong. So,
yeah, like you say, there's always these external factors that can come in that maybe some of us didn't, take into account into our analysis at that time. But looking back over what we've seen in the past year here, you wrote another article about how the silver price should have hit $50 in February. And to kind of set the stage for that, we saw the price move up by like $5.20 in 2 trading days. And that was really accompanied by a massive buying of physical inventories over the weekend. And that had kind of like forced some bullion dealers to actually shut down their websites out of fear of not being able to get demand. So how did that situation play out from your perspective, Nate?
So I'll tell you what, a lot of the legwork for that, I have to give credit to Ronan Manley. Basically, let me see this somewhere in the chart here. Up here it is. So basically, what happened was, the silver squeeze happened. Everybody went out and said, hey, I want to buy. And the dealers had to stop selling because, they didn't know if they could get some supply and the like. But what you had seen shortly thereafter was paper falling from the rafters. Now, some of this could have been legit hedges from, a lot of the dealers. They could have been buying supply and at the same time hedging it. But if you talk to some of these guys, they don't do a lot of hedging these days. So another bet could have been take a look at how overstretched the price got. And hey, I'm going to bet against it because I bet it's going to come down a little bit. But Ronan Manley did a lot of work on this as far as the details of this. And that article that you're talking about, I don't have up right now. But a lot of that had to do with there was some inventory games, basically where I think it was something like 100 and some million ounces were miscounted. And that just so happened to be about the exact number that a certain large ETF was supposed to put into their vaults in 3 days. And I don't want to name names here, but that was the accusation that if this ETF was not able to actually fulfill that 110 million ounces and they didn't have it, if that information had gotten out, as was expected, you would think silver potentially could have gone parabolic. Mm-hmm. And because that was able to be kind of pushed under the rug, if you will, we just accidentally miscounted 100 million ounces. Yeah, because of that and that information not getting out, they were able to tamp down the price, if you will, because if you had this major large ETF come out and say, hey, we can't fulfill this silver need, we don't have it, what would that have done to the market? Almost immediately. So I don't necessarily think a lot of us were wrong. I think it's possible that the other side of this, these people are much better at shell games than we gave them credit for. Mm-hmm. So you would think an honest person would be like, hey, we just don't have it. Let's just report that. And that's kind of not what happened. That kind of got brushed under the rug. They changed their prospectus overnight, essentially, as this was going on, saying we might not have the silver. So you have to give credit to Ronan on this because this guy was like, he's digging through the prospectuses on all this stuff. And if you put that and you piece that all together, it leads to a situation that, silver could have gotten really out of control very quickly because of how this stuff is all set up. So the futures market, as it is, if you had everyone running out and buying $50 silver at that time because they're hoping it got to $200, $300 silver, it would have completely overwhelmed everything. Mm-hmm. So the futures market essentially was there to tamp down the price, if you will, in advance. So it is what it is. And we're down to $21 silver last 2 or 3 weeks ago. So it gives an opportunity for a lot of guys to load up. I know the premiums have come back down a lot. But we'll see how this goes with supply in the next couple, 6-12 months with, what I was talking about with the silver and the solar and the energy and all that other fun stuff.
Mm-hmm. But Nate, if we take a minute to think about the available supply of tradable silver in the market, we're quoted with a figure of about 25 billion ounces, right? So in your opinion, is this all available at the moment, or when do we see the price start to rise with that will force some sellers to hold off and maybe wait for that momentum to drive the price even higher?
So there's another article I wrote about the whole supply thing, and you had a guest on your show who I actually love. A lot of people have some issues with him, but the guy, he's completely entertaining for me. But I've heard him and some others talk about the total silver stock above ground at like 25 billion ounces. I think the total available above ground supply total in all is like 60 billion ounces. It's said to be about 30 billion or so ounces are like in dumps everywhere, in TVs, mirrors, microchips, just in dumps, unrecoverable because it may cost you $300 to get that ounce out of something. But then there may be about 25 billion or so ounces that could be in jewelry, it could be in tea sets, it could be in things like that. Grandma silver, as Craig Hemke calls it. There could be a lot of silver in that in 25 billion ounces. True, absolutely. But at what price point are you tapping that supply? So that leaves about 5 billion or so, which is estimated to be in the bars, the coins, and I think 2.5 billion of that is owned by ETFs. So the total float I had in my article was somewhere like 1 to 200 million ounces, complete float. Okay, and that's not on the price sensitivity area. That's like, okay, if you wanted to go out right now and buy 100 million ounces or so, you could. It would be out there. Now there's also debate upon the registered and the eligible COMEX supplies. I don't want to go too far into that, but you're looking at one of them that might be 250 million ounces that are there, but they're not necessarily for sale at that price. So that might be an immediate supply if needed, if price points go up. But if you're thinking about like who owns this silver in this supply at this large level, and let's just think about you're dealing with some billionaires and millionaires out there that if they're holding this metal, it's their investment hedge. You know, they have 1% of their portfolio or 2% of their portfolio or whatever it is in silver or gold or whatever it is. They're not selling for $1 more an ounce. They're just not. That's their bomb shelter silver. Okay. That's in case the stock market goes belly up, their metals are going to go through the roof, and that's their hedge. So they're not selling that for $5 more or even $10 more. So that being said, as you go back to this 25 billion ounces, and if that's grandma silver, and if that's jewelry, at what price point are you selling it? Let's just say, for argument's sake, $50 an ounce, that a lot of this becomes available. Okay. Well, if it does, then what about the refineries? They got to take where does this junk silver, or where does this silver go? You know, the coin shop may give you some money for it, but then it goes to refineries to turn into bars or whatever. But these refineries get significantly backed up. So what I had heard in 2011 was that like coin shops were stopping, they weren't taking any more silver because it may be worth $40 or $50 an ounce, but their refineries were not taking anymore because they were backed up. Mm-hmm. So that was an issue you run into. And I know silver is one of those types of assets. I wish I knew what the name of it was now, but the higher it gets, the more people want it.
Giffen good.
That's what it is. Okay. So at like $28, $30, all my buddies are like, Nate, how do I get some silver? All of them. And so I'm talking to them about junk silver and all this other fun stuff. As soon as it hits down to $24, $20, $22, Nate, you're an idiot. Silver's going down. I'm like, dude, buy more. But the lack of interest. So at $30, $40, $50 silver, the interest increases exponentially. Mm-hmm. So where are they getting that silver? So as we all saw, you could, in a weekend, completely clean out global supply for the most part of the retail supply. So once those shelves are cleaned, what are they doing? They're going to your PSLV, you're going to your other types of things. And how long before a PSLV in those types of environments sucks up the rest of the silver? And not only that, I love Kinesis. You can buy Kinesis silver and they'll go out and they'll buy your 100 or 1,000 ounce bars or whatever it is, and they'll put it in their vaults and they'll pay you to store it. So how long until, if we're in a situation where silver does hit over $30, if Michael Oliver's momentum structure is to be believed, if this is going to have this next shelf, we may have 25 billion ounces of available supply. I get that. But how many refineries do we have? And how quickly can that supply meet the market? And my guess is the only way to keep that from getting out of control is the silver futures market. That's it. That's the only way. Mm-hmm. So if you sell a lot of these things, you will push the price down. So I think that 25 billion ounces is a misnomer. I think it's there, but it's not available. So at what price is it available and how quickly can it come to market are completely different conversations that I think some of these guys should address.
Yeah, those market dynamics that you just highlighted, that's something that we need to consider and think about as that price actually runs up. How much are they going to be willing to sell? But of course, as metals investors, we think about protecting our purchasing power by buying metals and guarding from inflation. So when you look at how inflation is measured, Nate, how does CPI relate to lower interest rates? You were explaining that to me earlier, and there's another interesting relationship there.
So we all have heard the conversations about 1970s inflation, and then Paul Volcker in 1980 turned 20% or whatever it was, 15%, whatever it was, high rates. Okay. So then we had this point of high rates from 1980. But at that point in time, I think our country only had the United States, I think we only had 300 billion in total debt at the time. So what basically happened then is, correct me if I'm wrong, but I believe in 1980 and 1991, they changed the CPI formulas. So when you change the formula, you're then able to kind of juke inflation down a little bit. So what it looked like, I told you the analogy of boiling a frog. Mm-hmm. And it looked like over the last 40 years, the CPI was artificially low. And what happens is if you artificially report inflation low, then what happens is, interest rates come down because there's less risk of a default and all this other stuff. I'm sure there's other reasons, but if we have a low inflationary environment, interest rates can start coming down. And what happens is if interest rates are coming down, you can borrow more and more money cheaper. Okay, so this allows businesses to expand. It starts inflating asset prices, but wages are not increasing because your inflation is like 1 or 2%. So maybe you get a wage increase in 1%. But if you're actually having 5 or 10% inflation over those 40 years, your frog is getting boiled slowly and slowly. And now all of a sudden, if we actually really do have 5 or 10% inflation, the CPI is reporting 5.4 with this new model from 1991. If we were using like a 1980 model, we might be well over 10, 12% inflation right now. The problem with it being is everybody that's come on your show has mentioned is you can't just turn around and put 20% inflation up, 20% interest rates because the country will go bankrupt at 1%. We now have 100 times the amount of debt that we did in 1980. So what I was mentioning with this whole inflation thing is that you've seen things like the Arab Spring in other countries where eventually what happens is their food costs go over 35% and you start seeing riots in the street. Well, our food costs are now at this point of inflection where, hey, a little bit of inflation is now tipping us at this boiling the frog area where now all of a sudden we're noticing it. We're not just doing, like a 1 or 2% inflation per year. Now all of a sudden we see inflation and you go to the store and you're seeing beef at 25% more than it was, 6 months ago. So now people are worried about feeding their families and their wages are not increasing, but their food may now be crossing that 35% threshold. So the concept with that was 40 or so years of artificially low CPI has led to a situation where I think a lot of people in this country are going to be hurting, especially when, now inflation is now they're saying it's not transitory. It's going to be here through mid 2022, maybe. It's supply chain issues. And if you think about it, if, with the Rafi, quote, if you're buying things that you need today and you're buying things that you need in the future, it's a self-fulfilling prophecy where you're now creating the supply chain bottlenecks, which is now further creating higher inflation. So you're going to then create a situation 6, 12, 18 months from now that only the people that have means can get goods. You're pricing a lot of people out of the market for things. You see it first with houses. What are housing prices like in Canada? You can't get, first-time home buyers basically priced out in a lot of places in Canada. Same thing here.
Mm-hmm. So when we think about, defining hyperinflation, and you mentioned this with Jack Dorsey's tweet earlier, how do you define hyperinflation, and how do you think about this? Let's say these cycles of inflation and deflation.
So there was this movie, Clint Eastwood was on, and he's like, "Get off my lawn." Well, there was a guy on Kitco maybe about a year ago that was talking about inflation. It was hyperinflation was defined at 50% month over month.
Mm-hmm.
Now, this guy seemed to be like he was an economist. He was a PhD. He knew what it was. I don't remember who it was. So if you're out there watching this, please don't be offended by it. But the concept was I saw him on something else, and he got very defensive on it that this was the official definition of hyperinflation. And I started thinking about, you got the Weimar hyperinflation everyone here that watches this knows about in the 1920s. But, a lot of people that are younger may not know about how Russia's currency went terrible about 30 years ago at the end of the Soviet Union. A lot of people in this country don't watch the news, and they may not know what's going on in Venezuela or Turkey or Argentina or what happened 10, 15 years ago in Greece. They don't know about a lot of these things. And even the Zimbabwe $100 trillion bill that you see. So a lot of people don't know about these types of high levels of inflation or hyperinflation. And my suggestion was to the PhD economist guys out there, I would suggest hyperinflation is the structure or the process to get to that point. What's going on? When can you define a hyperinflation? So right now, you might be looking at it like, well, we just have 5% year over year inflation. Well, it's only 0.2% month over month, so it's not hyperinflation. But if you correct for inflation that actually has been going on since 1980 and not looking at the CPI, where are we at? Did that stuff start looking hockey stick? Are we now at 12% year over year actually? And the question is then, what is the structure that leads to hyperinflation? What has happened in Lebanon? What has happened in Turkey that the Turkish lira is something like has lost 8 times its value to the dollar in the last couple of years? So what is structurally going on there that creates these high levels of inflation or hyperinflation? And when can you actually declare hyperinflation? Are you waiting until we're at 50% month over month? Or wouldn't it be smarter to look at we're in a hyperinflation structure now and then deal with those consequences now to prevent that from the future? So my thinking it wasn't to be so literal on the 50% month over month, but more or less trying to identify the process to get there and kind of look at it like that. So Jack may have been a little bit off with the hyperinflation right now, but it doesn't mean that he's incorrect that we're not on our path there.
Mm-hmm. Yeah. And thinking about dealing with that situation now, there's no way we would ever be proactive about the situation instead of just reactive. And it's not like there's the political appetite there to be able to do that as well.
Most definitely not.
So going back to that other question of how do you see these cycles of inflation leading to deflation? How do you conceptualize that? And do we maybe see deflation occurring in some sectors while we see inflation in others?
Well, I've written a bunch about this as well, and I can tell you got different camps out there, and you have a lot of guests that talk about these types of things. And if you want to get into the weeds on those things, talk to them. But I'm looking at this from a 50,000 foot view. Mm-hmm. Is if you're looking at right now, we have inflation. Well, inflation is because you're hearing Jerome Powell's talking about we're in a dangerously deflationist state, and we have to average in higher inflation. And I'm like, how do you think we're in deflation? Well, if you talk to the economists out there and those guys, and you look at those interest rates going down over the last 40 years or so, they would say that was a deflationary environment. And we've talked, a little bit offline about how you'll have certain things like IT, with Moore's law, you're twice the processing power. IT and technology increases it twice or so. The capabilities every 18 months. And those types of things tend to be deflationary. And when you have a mortgage rate at 15% over 30 years, and you can refinance that to 12%, that's less money that the bank's going to be getting. So over the course of time, those types of things can be deflationary. However, it was artificially reported with the CPI. So right now, I would say we're in a high level of inflation, but we've been in a high level of inflation that was kind of masked by a low CPI to make it look like deflation. So there's a lot of things going on like that. And ultimately, they talk about if you're in a high inflation or hyperinflation scenario, that it kind of burns out pretty quickly. And, whether you're in the camp for, who is it, David Hunter, who talks about we're in a melt-up situation right now, or if you're in a Harry Dent where we're just going to collapse right now, depends whatever camp you're in. If we're in a situation where this inflation does increase and increase and increase, you run into a situation where a lot of people get priced out of buying it, and then things get caught up on the store shelves, but nobody can afford them. So now all of a sudden it's deflationary quickly, because now all these people that produced all this stuff now have to sell it, but they have to sell it at much lower prices. So this can be, as Hunter suggests, it could happen like this. It could be a melt up that we're in right now. I kind of like the whole concept of the Michael Oliver arm wrestling thing that's going on right now. We could also be in a double top situation with some of the indexes right now. We don't know what's going to happen, but these inflationary and deflationary cycles, the problem that you run into with all this is, like I mentioned in my previous videos, that my previous background dealing with metrics. You want to count apples and oranges, and you want to be very truthful to the customer what performance was. Well, if you're juking your CPI numbers, and then all of your fiscal and monetary policies based off these juke numbers, you're going to create all these situations that are artificial. So right now, it's just a lot of things are going to have to really, get corrected with the correct metrics. Where are we at with inflation? Anybody watching this knows that house prices year over year, like 24%. But what's the CPI reporting rents at, like 3% higher or 4% higher for housing rent equivalent? No. And people will reject those numbers. And as people are getting more and more involved with the inflation narrative, they're starting to understand this and reject those narratives. And I think, to my point, I think that's going to just kind of escalate the situation of people trying to buy more of what they need now. Their future needs, they're going to buy more now.
Like you say, moving that time preference up a lot further, just to be able to get rid of those dollars for the value that they hold today, right?
Yeah, that's where I was talking about with you, where, a year and a half, 2 years ago, I'm buying junk silver. I'm telling all my buddies, buy junk silver at like $16 an ounce. They're calling me nuts. And then also you have a situation where, a year and a half ago, I built a pantry for like a year's worth of food. And I told you, the other thing where, I'm worried about my energy consumption. So I'm even looking at solar at the moment. So I think a lot of people are also going to be going down the concept of energy inflation costs. I mean, you're looking at this right now. All these people are talking about high natural gas prices. They're talking about, shortages in China. They're talking about, green energy, and think about California with all the rolling blackouts they have. What I'm sitting there thinking to myself is, hey, I want to ensure I have energy production, and I want to ensure I'm buying it at today's prices. And I don't want to look at, paying an electric bill a year from now 3 or 4 times of what it is now. So if I can get solar now and put it on my roof and lock it in and equivalent my energy bills 10, 15 years from now, how much are those energy bills going to be? So, I think a lot of people are going to be in this inflation narrative I think we're at the beginning of the inflation where people start acquiring things. Many of us that are watching this are way ahead. They're way ahead. So we were also talking a little bit with the solar and stuff and how, the solar requirements are 100 million or so ounces per year. It's like 1/8 of all mining. So what happens if
for
people
silver.
watching, for silver. So what happens if people watching this, and many other people are going out there and saying, hey, I need to buy silver now. We double or triple the requirements for silver. What's the industrial requirements going to be? And at the same time, we're going through high levels of inflation, and a lot of these people that are coming into, crypto are understanding, the gold and silver narrative. What happens when a lot of people start getting into that? And a lot, Rick Rule talks about the 30-year mean for gold and silver is at like 0.5%. What happens when that starts to revert to the mean of 1.5%? So I think you're going to have this whole collision of industrial demand and investment demand combining, not just us cleaning out, in a weekend cleaning out retail. I think it's going to be a much bigger thing. And that, I think, is what is the underlying narrative here with inflation. I think if we're just at the start of that, and if we just broke the trend with silver with these beatdowns over 15 months, it's quite possible that that bottom is really in. Now, could we have a flash crash with the DXY and an accident in the market? Yes. But it seems to me like all of these things with inflation people are going to be buying a lot more coming up. So those are the big ideas with that.
Mm-hmm. So another one of your big ideas is kind of how, you put this presentation together about gold being the center of the financial universe, and how, something we've talked about on the show quite a bit recently. And, you're seeing headlines of it all around the world right now, are higher energy prices, blackouts, and really energy coming into the focus of many people's, let's say, consciousness, because all of a sudden it's in shorter supply. So how do gold and oil relate to each other in your conceptualization of that financial universe?
Well, that's probably another 5-hour discussion, but at a high level, I took a look at gold to oil, and it looked like it was something like about 2 grams per gold can buy a barrel of oil over the last 50 years or something like that. So there was a constant kind of oscillation with gold to oil.
Do you want to pull that chart up?
Let's see if I can get that up here real quick.
Perfect.
Okay, so what you can see from a chart like this was basically, I was going back to 1971 when we went off the gold standard. The big picture here was, I kind of thought, and I'll show that in another fun slide up above, but it was basically that gold has this relative value to things like oil. Okay, and so gold and energy are kind of tightly tied in value. And there's certain points of time where you might want to sell your gold and buy oil. Other times you might want to sell your oil and buy gold. And this is kind of a little bit of the Maloney wealth cycles kind of things, where I was looking at relative values to things. And when you can see this, let's see with that. And that would be the price of oil in dollars over the last 50 years or so, or 70 years. And you can see how erratic it gets. But when you actually relate things to gold, and I did this with a lot of other things. And so I got like this 5-part series. I got a video series about all of it. So I can't get very far deep into it now. But to me, it reminded me, let me see if I can pull up the this thing here. It reminded me of back in the day when I was learning about all of this kind of fun stuff. It was a heliocentric model and geocentric model of the orbits. And to me, it looked like gold was the center of everything. Gold was the money. This is how you acquired things. It was the medium of exchange for like 5,000 years. And in the right-hand side was the geocentric way of looking. Like, the Earth is the center of the universe. And what you can tell is you're able to make that model, but look how convoluted that is. But look how perfect the heliocentric model is. So what I was able to do with that was kind of look at a relative value of gold to all other things. So that was the big picture with that. I didn't know how far you wanted to dive into that, but it tied on to a lot of my other theories with energy that I was inspired upon by other people recently. I think a lot of the energy problems we're running into today, a lot of them are self-inflicted gunshot wounds. And I do agree 10, 15 years from now, we're going to have a heck of a lot of problems. But I think right now we have a lot of political issues where, it may be not politically correct to turn on the nuclear plants, but you can. So if that happens, you run into a shortage. Mm-hmm. It may be not politically nice to dig coal out of the ground and fuel electrical plants, but that's what we run into. And I think these self-inflicted gunshot wounds, if you will, I think if these things are not corrected by politicians, I think they will, but if they are not, they're probably going to get voted out of office. And I say that because if these energy prices start going up and start going crazy where I think they're going to go, relatively speaking to gold, if these energy prices start going through the roof, what's going to happen is you're going to have a lot of people crying about price ceilings, price controls for things. Hey, these greedy energy people, they're charging you too much. And we saw this in Texas last year when there was like this freak ice storm. It came down to greedy energy companies and why were they allowed to charge so much? Well, if you're running into a situation like that in this country or other countries, you're going to have a situation where they're going to say, well, okay, there's a limit on how much you can charge for energy. And with that, the energy provider is going to be like, fine, I'm just going to create a shortage now because I can't produce that with a profit at that price. So when you start to have these rolling blackouts all over the place, how politically viable is that? So one of two things are going to happen. I like how Rick Rule says, either the price is going to go up or the lights are going to go out. And that can be kind of also, with politics, either the coal is going to get into the furnace or you're going to get voted out. And the flip side of that is I really think that you're going to see with these rolling blackouts, you're going to see a lot of people saying, hey, look at this. My energy bill is 3 or 4 times what it used to be. Well, look how cheap solar is. So you're going to see a lot of people trying to reduce their energy costs by actually going green. So while they can.
Yeah, which is, interesting to think about all of the commodities that have to go into producing solar, producing all of these new, all of this new energy infrastructure, because when everybody rushes into that, it's just going to make the demand and the price skyrocket when, that supply isn't, or it's possible that supply doesn't actually get met, right?
Absolutely. I mean, like I said, if you're looking at energy bills that are 2 or 3 times what they are now, if they're, it's possible you're like, oh, well, I'll just use a generator. Or, what happens when your natural gas prices go up 8x, and your backup generator that's running on gas, goes up 8x. I mean, your fuel costs are going to go insane. So I think collectively across this country, in an inflationary mindset, I think a lot of people are going to start thinking about, well, how can I buy my energy prices of tomorrow today? And, a lot of the things with this inflation are people think this inflation is, well, it's going to go up and then the prices are going to come back down. No, what they're talking about is the prices are going to go up, but the rate of change is going to slow. So no one look what Jay Powell is saying. There's no one saying the prices are going to come back down to where they're at. If a company can charge more money and people are buying it, they're not going to reduce their prices. Look at the shrinkflation. They're trying to trick you into buying less for more. So it's kind of the same thing. I think people are going to try and secure as much energy as they can for the future today.
Excellent, Nate. As we wrap up here, is there anything else you want to add? I know we've covered a lot of topics here.
I think that just about covers it. As anybody that knows, I'm found at the renaissanceman.com. And with that, it's just, I love writing about a variety of different things, big ideas. So a lot of you guys out there that have been on Tom's show, I'll turn around and write a lot of things about it. So bottom line is, I love how a lot of you guys have come on here. You spark my interest in things, so a lot of big ideas. And then you have people like myself that would love to sit at the table and be like, hey, you know what, you're bringing up a problem. How can we come to a solution for some of this? So this is where we talked a little bit about some of the battery solutions of the future and all that other fun stuff. And that's another topic, another day. But I think to conclude here, I like the idea of people talking about big ideas. There may not be perfect solutions right now, but I like the idea of people talking about a lot of this.
Yeah, and it's excellent to read all of the articles that you put out, Nate, and to kind of see what you're thinking about and how you're thinking about these big ideas as well. Of course, that blog is renaissancemen.org, and you're available on Twitter as well as Nate Fish PA. Of course, we'll have all of that in the show notes. Nate, thanks so much for sharing your time and your big ideas with us today.
Thanks for having me again, Tom. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.